You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and your author of the Options Playbook. Now, last week we had a lot happen. We were kind of following a trade in Costco, and we decided to go off on two different tangents in that we looked at a butterfly. We talked about it the week previously, and then the day that we taped happened to be the day that they were announcing earnings. We kind of changed things up a little bit. So we thought we'd compare what an at-the-money butterfly would look like in Costco versus an iron condor. We changed up the times, and we did the butterfly near term, and I talked a lot about why we would do a butterfly near term and why we would do an iron condor, and even though it's around earnings, go further out in time. And so they announced, and we're going to get into it today and which trade did better and why. And we're going to talk a lot about it. So if you happen to have an options playbook on your table and you'd like to follow along, the two strategies that we're looking at is a long butterfly with calls and an iron condor. So the long butterfly with calls is on page 102, and the iron condor is on page 126. Now, if you don't have a playbook, don't fret. You can always go to optionsplaybook.com, and all the plays are in there. Just click on the strategies tab and look for the plays. So let's summarize what we did last week, and then we're going to get to a new trade this week. This week's stock that we're going to look at that's going to be announcing earnings next week is another couple $100 stock, and it's FedEx is the symbol. FDX is the stock that we're going to look at. So with Costco last week, we actually had a really good scenario for our paper trade that we placed for both the iron condor and for the butterfly. So I think it's going to be a great learning experience. So I wanted to spend some time on it. So let's go in and recap the trades real quick. So March 7th is when we placed these trades. And after the close on March 7th is when Costco was going to announce their earnings report. The first one that we looked at was a butterfly on that day. The market was at about 186. We rounded off a little bit there. And we looked at buying a 10-point wide butterfly with the March 9th expiration. So we bought a 175, sold two of the 185s. That was our center strike, and then bought one of the 195 calls. Now, at that point in time during the day, the market was trading at the midpoint at $3.85. You had a 10-point wide trade, so the maximum this thing could ever trade for would be if it went out right at 185, right at expiration, you could make 10 points. So 10 minus the total risk, which would have been $3.85, gives you the maximum that you could make on the trade, which would be $6.15. Okay. So that was the butterfly. That was a very aggressive trade. There wasn't much you could do on it if you were dead wrong. The expected move, I should have probably mentioned, was 7.5 points at that point in time. And that the March at the money call and at the money put were trading at the midpoint for about $7.50, implying that the market is expecting that type of move, not necessarily to the upside or to the downside, but that gives you a range in what the marketplace thinks could happen by that Friday expiration, March 9th. Now, that trade did well because of where the stock went at, but let's introduce the long iron condor and talk about what happened with that trade. So I mentioned on the call last week that if you go further out in time, the options obviously have more time premium, and because of that fact alone, Vega is a larger number than the shorter term options. Now, on a percentage basis, it might not be a bigger percentage of the actual option contract, the out of the money contracts that we'd be looking at here, but it is a big number. And so a 1 percentage point move in implied volatility is going to really affect the longer term options on a purely price basis. So here's what we did. Market at 186. We looked at, and because we're going further out in time, we went wider. Our butterfly that we looked at on the short term was a 10-point wide butterfly. We were able to go almost 15 points out on both sides on the call and the put, give or take a little bit of rounding because of where the market or because of where the stock was at. But with the stock at 186-ish, we went out, and I'll start from the top. We bought the 210 call, sold the 200 call, sold the 170 put, bought the 160 put. Okay, so we still got 10 points of risk here because we're 10-point wide on the put spread and we're 10-point wide on the call spread. We were able to get that entire trade done for $2.10. That was the midpoint, but this is just on paper, and like everything, we're just trying to learn on Options Playbook Radio. All right, so if we did it for $2.10, you take the width of the spread, 10 points, minus that $2.10, and you come up with $7.90 is the total risk. Now, we're not going to stick in this trade. It was a 45-day trade, I think, when we put it on. And our plan is to really just get out of it after earnings, have the event happen, maybe adjust if something really bad were to happen in the trade. But because we have longer-term options, we have that ability to adjust. All right. So when we go out and look at what happened, the next day, Costco announced earnings, and I'm just going to look at the Trade King chart here, and not much happened after that. The high for the day after the earnings announcement, so we're now on the 8th of March, the high was 186.35. The low was 183.08, so it definitely didn't move the expected move. 183.08, and it closed at 185.69. So I just took a screenshot of the option chain at the end of the day, and I just did the math. And what's amazing, which I would have expected anyways, the market closed at 185.69. So obviously the butterfly is going to be the winner here because it almost closed right at our center strike. There was still one more day of trading. But that butterfly at the close, at the midpoint, was trading around $8. So we put it on for $3.85. In theory, if you didn't get out at 10, 11 o'clock in the morning, which you probably should have, we've always talked about that. You should never just stick around on a butterfly and hope you hit a home run. But if you stuck around to the end of the day, you could have sold the entire butterfly for a net credit to your account of $8. You paid $3.85 for it. So $8 minus the $3.85 that was paid for it, that means that you could have made $4.15 on that trade. Your max risk was the $3.85. So there really wasn't a anything that you did wrong here on this trade, and you would have had to just get out. If the market moved that 7.5 or more points, you would have just wanted to close the trade and get out anyways. But it just shows you the power of implied volatility. One day, one major event, this thing is trading for 385 when it was at 186. The next day, it closes almost right there, and the thing is now trading for $8. And that's all implied volatility crunch. You could say a little bit of time decay. I'm sure that that's a factor too. But bottom line is the implied volatility was the driver. And this just proves that when you put a butterfly on, you want implied volatility to decrease in your option contracts. You want time premium to come out. The concept is the only way you can get the maximum of butterfly is if you could buy your center strike back, the options that you sold in the middle, in this instance, the 185 for next to nothing or zero. That's the only way you can get the maximum back on the trade. So what happened with the iron condor? Well, it didn't do as well, which is expected. But if you stuck around for the whole day and you put on that trade, you could have actually closed that trade out at 80 cents. So it was trading for about $2.10. You could have closed it out for 80 cents. So it actually did better than I would have expected because there were so many more days remaining on this underlying at $186 stock, but you still had 44, 43 days. So implied volatility did just like we were talking about. It really affects long-term options on a pure price basis. So you put it on for 210. Could have took it off. We're going to say 90 cents. All right. So $1.20 is what you could have made if you stuck in it for the whole day. But I personally, if I was up 50 cents or 60 cents, I would have just got out of that trade at that point in time. But there was no reason to adjust those trades. So obviously, you didn't knock it out of the park by doing the iron condor, but it's just a much different trade. And to get that much off of just flat out volatility crunch, because that's 100% volatility crunch, not really a ton of time decay at all on it, just because our forecast was correct and it didn't move as much as the marketplace was implying. I just makes you think about what you want to happen when you go and you put these trades on and how time value, especially on these expensive stocks trading north of 100, 200, even north of $1,000 like Amazon. And last week we looked at Priceline, which was actually now booking something. I don't remember what they changed it to, but bottom line is these type of stocks, you really want to think about what's going to happen as far as the Greeks are concerned when you put those trades on. Now, the upside of the iron condor is that if you were dead wrong, there are many things you could have did. Let's say the market did move more than the expected move. Let's say it moved 15 points. It got down to either our short put or our short call. In that instance, because we had so much time premium, you could have closed one side of the trade and maybe just butterflied off the trade that you were doing. You could have adjusted it. You could have rolled it. The time premium would save you if you were wrong on the longer term trade, on the longer term iron condor, because if you're dead wrong, all that time premium is going to help you. It's going to help you not only adjust the trade, but maybe just close out the trade. Whereas on the short-term butterfly, there's no time frame. There's nothing left. It's really an all or none trade when you're doing just a flat-out butterfly on that. Okay, so I'm running out of time. I'm got a little long-winded on that, but I thought it was a real interesting scenario because it really just showed the pricing and everything that we've discussed a lot on Options Playbook Radio. So now let's look at FedEx. FedEx, today we're taping Options Playbook Radio, and it is the 14th of March. It is Wednesday. The markets are closed. FedEx closed today at 246.91. 246.91. We have earnings that are going to come out on the 20th of next week. So it's going to be, this trade will be after, we'll be taping Options Playbook Radio after earnings. On Wednesday, the 21st, we'll have the whole day of trade. So we'll be able to see what happened. Now, I'm just going to put on a butterfly, $246. Once again, we're going to look at the expected move in the underlying. Right now, implied volatilities are fairly low relative, as far as an earnings report is concerned. I'm showing them trading at 35%, which puts the expected move at 11, plus or minus 11 approximately. So 35%, if you buy the put, you buy the call, you're looking at plus or minus 11. So we're going to want to be further out than that. Now, we would wait and usually set this up the day of in FedEx, but we're going to look at the trade right now, and we might adjust it. We might talk a little bit more, but this is how I would set it up. I would do much the same that we did last week in Costco. We're just going to go at the money with the expiration that will contain the earnings, and that's trading at about a 35% vol. We're going to go as much at the money as we can. The stock on the close is 246.91. Let's call it 247. So we're going to look at the 247.50, and we're going to go more than 10 points. So we're going to look at moving 15 points wide on this underlying. So we're going to have a wider butterfly, and going that 15 points to the downside means our protection on the call side. Once again, we're going to be using calls, long call butterfly here. 232.50 would be the call we'd look to buy. 262.50 would be the call on the upside we'd look to buy. We're 15 points wide, so it's going to cost more because we're going to have more upside if we are correct on this underlying, as opposed to last week. We had a lower price stock and we were able to do it 10 points wide. The net debit is $6.48. I would expect that to get a little bit lower as implied volatilities increase. As we get closer and closer to the earnings, this butterfly should come in and actually trade a little bit better. But we're going to call it $6.45. So that would be our maximum risk. We have 15 points of upside minus $6.48. If we can fill at the midpoint, means we have $8.52 of upside on this trade. If we are 100% correct, $6.48 is our max risk, and we're just going to put this trade on. We'll look at it. Might adjust it next week. I'll look at what happens after earnings. I'll take a screenshot of the option change so that we can talk about it, and we'll just see how this one works out. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.